now. Well, let's talk about markets in some more detail. Sridhar Sivaram is Investment Director at Enam Holdings and he's with us here in our studios. Sridhar, great to have you with us here. Thank you very much. It's been a while, so good to speak with you. Where do you and your team stand, Sridhar, now with the markets come up so fast, vigorously and furiously?
So our broad view is that this is a year where we're going to see these ups and downs. It's going to be more a sideways. It could be range bound. So when the markets go up, you'll feel like you missed out, and then you'll get an opportunity when markets come off. And there'll be so many news flows that we are going to get. We already got so much, and we are going to get so much more. And I think more globally than domestically. So if you ask me, you have to look at bond yields in the US, in Japan. I mean, when were we talking about bond yields in equity markets? But that's the reality, that you have to watch them very carefully. They can have a massive impact on global equity markets. So I would say the global macro is looking a bit more questionable. Surprisingly, Indian macro is looking very good.
Very, very good. And it's happening also fast, right? By the time you get ready to do something in one direction, it's done. I mean, and then you're looking.
So it's
Are we at the top end now, Sridhar, you think? Oh, this range that you're talking about, up and down.
So it's very difficult, Prashant, to say what is the top end, what is the bottom end. It's better to look at stocks that you like and figure out a price which is you're more comfortable with. At least for us, it's easier that way because we don't have a benchmark, we don't have a competition. So it's easier for me to say all this. I'm sure it's not the same for others, where if you're getting so much cash into your fund, you don't have a choice but to,
So when you were talking about a range, you were talking about indices.
Yeah, in the index. But then index is composition of where the stock prices are, right? Correct. So so you'd look at the index and you feel there's a range. I mean, there's only that much the market can go up if earnings don't support. Plus, you need global macro to support. You can't have that India goes one way and the rest of the world doesn't support.
So let me ask the same question slightly differently. It started to get a drift. Simple question is, minus the flows, whether local or global, X of the flows, do you get the sense when you hear corporate commentary, when you look at the earnings profile, when you look at on-ground visibility, do you get the sense that this market at a broad level has a lot more steam to go higher? No.
Simple answer.
Simple answer is no.
Yeah.
So, okay, let's drill down a little deeper then. So, for a market like this, which is not going to have this overall gush of, momentum, how should one approach it? Which are the pockets to look at? What should investors be doing over the next 12 months?
So, I'll tell you what is good for the market, how I see the market in the, say, next 9 months, 12 months. So, we are entering a phase, I would say, a golden phase of inflation. I mean, next 9 months, we could see average of 2.5–3% inflation.
In India?
In India, I'm saying.
Whoa!
RBI is going to significantly bring down the inflation forecast when they announce their policy on June 5th. When they announce, obviously, there'll be more credibility, but we are entering a phase. So what will happen is we could see a 50 basis points rate cut in June itself. I mean, these are my and our predictions. We could go wrong, but based on the numbers that we are seeing, this is how we are seeing. We need support globally. If Fed doesn't cut interest rates, there's only that much that India can cut. If we get support globally, we could see 100 basis points of rate cut, which basically means that we are currently seeing a slowdown in consumption. We're seeing a slowdown in credit growth. All of that could change because with the lower interest rates, imagine if mortgage rates were to come back to the heydays of 7–7.5%. Demand for real estate can go up. So I think a lot of things will fall into place. So currently we have an issue where demand for credit is poor, consumption is poor. But if these numbers were to play out over the next 9 months, and we'll know a lot by June 5th when RBI will also come out and give their numbers.
You think it's warranted? I mean that's a really very clear call that you're taking. 50 basis points in June, maybe 100 basis points over the course of the next 12 months. You think those kind of rate cuts are warranted and you're expecting them?
I think it is warranted because our growth is slow and we are not going to get these type of inflation numbers. I mean, the last time we saw such inflation numbers was, I think, in 2018–19. We could see some months inflation below 2%. So we are actually entering a phase which is very good for us.
Golden phase.
Yeah, I mean, if the RBI, and we have a governor now who's pro business, also pro-liquidity because that was the other concern. So if you see, some experts believe that the 25 basis points rate cut has already happened because that's where the call rates are. They are below the repo rates. So we could see very proactive measures from the Reserve Bank, backed by very solid data. So if the inflation is below 3%, there's no reason for you not to cut rates. The question is, what is the differential that you're comfortable between our 10-year and the US 10-year? We're already at the lowest that we've seen in the last 15 years. So I think that's the challenge. So if you ask me, as I said, the global macro is looking challenging. Indian macro is looking extremely good. We could be in a golden phase, at least for the next 9 months in terms of inflation, which is what people look at. I mean, and inflation directly affects stock markets. If this plays out well, then what I'm saying that in the next 6 months or 9 months could be a consolidation phase, which can then build into a the next bull market. I mean, earnings have to follow through. So you take baby steps right now and build your portfolio for what comes in the next 9 months.
All right. What about the breadth of the market? You know, the small cap in universe had gone bonkers actually earlier, you know, stocks flying around, and then it cooled off. However, we have seen a lot of the small caps, you know, broader market stocks may not be best in quality, but they have bounced back. How much of that froth that was there in the market, how much of that has cleared out? Or do you believe there's still a lot in the market that needs to clear out?
I think a lot has cleared out. I mean, the frenzy that we had seen sometime, late last year, a lot of that has cleared out. Obviously, there'll be some pockets here and there which will still have some froth, but I think a large part is cleared out. If earnings follow through, I mean, for small caps, you need strong earnings. You don't pay 30, 40 multiple if they don't have, similar earnings growth.
Yeah.
And if earnings don't catch up, then they will correct on their own. Plus, the liquidity has been very strong for them. I think eventually everything boils down to earnings.
All
so
right.
if your strong earnings and the visibility is good, they can sustain. And we've seen, many darlings of the market collapse because of poor earnings.
Okay.
So I think that's how I would put it. It's becoming a very stock-specific, bottom-up market. If you ask me sectors, I'll really struggle because you can't really find sector winners right now, but you will find a lot of stock-specific opportunities.
All right, what are we talking about darling? The darling has been gold, right? And we have to talk about that. What's the probability we see a big pullback on gold from here on? And
Yeah.
I know what you're going to say with regard to you need to buy gold at every level in a staggered manner.
No, so actually, first I want to clarify some of the myths on gold because I've seen, a lot of people are talking about gold that, now 20-year, 15-year gold is matching the sensex returns. And the general, commentary I heard here is that it's because of the last 2 years that the gold is matching it. People forget because there's a recency bias that the best period for gold was 2004 to 2011. There was a 7-year period when gold gave a CAGR of 25%, when sensex gave a CAGR during the same period for 12%. So that was the best period of gold. Then gold has had continuous returns, small, but it has continued. And then we had last 2 years, which have been very good. I think the same will happen, that when you get strong returns in gold for a few years, you'll see some moderation in returns. We've had a 50% jump if you take the last 1 year. Can't have 50% returns in gold every year. So it'll moderate for a while, but I'm still very bullish on gold, only because of the fact that if central banks across the world are having a very loose monetary policy, QE in some form or the other is continuing, we'll see that reflection in either Bitcoin or gold. I don't understand Bitcoin, so I prefer gold.
I take your advice very seriously. As a percentage of your portfolio, how much would you recommend?
10% is my view. Different people will have different views.
I think Nigel is more. Huh?
I've been following, yes, Sridhar. I mean, for the last few years, my daughter's 4.5, 5. So every year, a little bit, and I always say, thank you, sir.
Sridhar, come back to stocks. And,
Sure.
And what's the... Give us some...
Yeah, so you mentioned one of the stocks today which was hitting upper circuits. We are very bullish on the power equipment space. So if you see, it's a global theme actually. So if you see, India will possibly double its solar and possibly double its wind. We may add 60, 70 gigawatts of even thermal. When you get so much of power which comes into the system, it has to be evacuated. So I think the entire value chain will play out. Some of the stocks are very expensive, so you have to play out, you have to figure out which one you prefer. But you get a lot of opportunities. In bad markets, you get some of these stocks.
We had one opportunity. I was just looking at Hitachi,
Yes.
for example.
Yeah, you had-
Heading from 16,000, went down to 9,000.
You look at the entire power equipment space, they collapsed sometime in March.
Correct.
You could have bought any of them 30-40% below where it is today. So I think it's as I said in the beginning, that you have to figure out what is the best price you want to buy certain stocks. And this year you will get multiple opportunities. That's how I look at it.
So okay, power is one. Let's dive a little deeper, because I'm very keen on, as you said, build the base for the next phase. So what else?
So
Where
the
else should
others
positions be
is
built?
financialization of savings.
Okay.
So if you think our markets will give 15% CAGR returns, say over a longer period, obviously it's cyclical, you cannot predict on a year-to-year basis, and you think that at least 10% volume growth, then the mutual funds and the wealth advisors, if you plot them ahead, say if you look at them for today's earnings, it will look expensive, but if you plot say 5 years ahead, then it starts to look interesting, that they can compound say over at least 20% on a 5-year basis. Obviously there will be cyclical years where you don't get earnings. So financialization of savings obviously is a theme that looks interesting.
On that, so that's the more capital market related plays. But
Exactly.
So, but on finance, and you mentioned that with the RBI cuts, credit growth should revive.
Yeah.
I hear a big debate in the market now, Sridhar, between whether the best is over for the larger banks. They simply can't grow at that pace. Don't expect HDFC Bank to keep doing what it did over the past decade. Do you agree with that, A? And if yes, then what are the alternatives? Where else? I mean, what are the kind of lenders should one be investing in?
Yeah, so I think I broadly agree. And the other thing is that unlike past periods when we had rate cuts, now it is different because at least 30 to 40% of the loans are linked to MCLR. So as soon as there is a rate cut, your NIMs immediately take a hit. Whereas in the past, it wasn't as much. So the hit on the NIM was far lesser. So if RBI was to play according to what I'm saying, then we could see NIM impact in the next 2 quarters. In fact, most banks that I've met in the last few days have sort of indicated, even without this assumption of a 50 basis point, then at least 25 is anyway going to come, that you will have NIM impact in the next 2 quarters. But I think the market is broadly prepared for that because if you get volume growth and if your credit quality starts to improve, because we've seen a cycle of poor credit quality in the last 6 months, and if that were to improve, especially with the large cap banks, you could see, mid-teens earnings growth. But I would agree that's what you can expect from large banks. I mean, if your book size, if your loan book size is 20 lakh, 30 lakh crores, there's only that much you can grow when the macro is not supporting. But if the credit growth were to come back, then a lot of things will fall into place.
Sridhar, you want to leave us with one name? With full disclosure?
Like, give us 2.
Maza to tabhi aayega.
No names at all. I mean, not in my last 30 years I've given out a name, so I don't think that changes.
Because, I mean, you guys are, there is so many niche opportunities. Right? We talk about the bigger sectors, but the meat is in the smaller
hidden gems, as they're called.
Right?
Prashant, all that glitters is gold. Prashant is saying 10%, no, 25% of his portfolio.
It's already given
Gold is an easy one.
Gold has beaten Sensex for 20 years. See, Nigel has listened to what I was saying. So what does you're not expecting more than 15% returns, right? On a CAGR basis.
Yeah, absolutely.
Gold has
Be very happy.
given you a name.
Why bother so much? Itna dimag lagane ka kyun? That's the sense.
Don't go with
Should be your husband's message that later this evening you will be gifted some. All right. Thanks a lot, Sridhar, for
Thank you
joining
very
in
much.
and giving us all of those details. Well,